Hello friends, I hope you all are doing well and staying safe at your own place. As I have told you in my previous lecture, today we are going to do revision of each and every topic that I had covered in the subject of financial management till date. So if you have missed out any topic or if you want further clarity on any topic, this lecture is just for you friends. So let's start with the chapter. The name of the chapter is Financial Management Introduction. The first slide was about the meaning, like what is financial management. Just to cut it short, I would like to say that financial management is the combination of two words, that is finance and management. What is finance? It is something which is related to financial activities, which is basically like procurement and utilization of funds, which means पैसा आएगा कहाँ से और पैसा यूज कहाँ पे होना है. That is procurement and utilization of funds. What is management? As we have studied in our 12th standard, it is planning, organizing, directing, and controlling. So I need to merge both these words. Then I could say, what is financial management? It is regarding to planning, organizing, directing, and controlling of procurement and utilization of funds. So whenever I am doing any activity with regards to procurement of funds and utilization of funds, it is under the purview of financial management. Second is the definition. I have given you two definitions, so I would request you all to learn both of them. The first one says the activity concerned with planning, raising, controlling, and administering of funds used in the business. So basically, I'm focusing on the 4 points, that is planning, second is raising, third is controlling, and fourth is administering. Planning means to plan how much capital do you require to do or fund a particular project. Second is raising, which means once you have decided that you want suppose 1 crore rupees for a project, from what sources you are going to raise that amount, which bank you are going to approach for loan, how much of your own capital, equity capital you are going to use. It is a part of raising. Third is controlling. Controlling is basically maintaining a proper check and to see that whether you are spending the appropriate amount what you had decided for on a particular thing. You are not spending more, you are not spending less. And last is administering, that is managing your funds. Basically, this is about financial management. The second definition talks about financial management deals with procurement of funds and their effective utilization in the business. So this definition basically talks about broadly 2 points. One is procurement of funds, that is how much amount is required, from where I'm going to get that amount, what would be the cost of capital, etc. And second is effective utilization, that is investment in my particular project. This is about definitions of financial management. Next was nature of financial management, which was focusing on the characteristics or the features of financial management, under which I had written certain points. First is it is universal. That is, it doesn't matter whether my business is a small business or a big business, whether I'm running any partnership firm or I'm running a company. This concept of financial management is applicable each and everywhere. Second is it is a continuous process, which basically emphasizes that financial management is not a one-time activity. It is an ongoing process. Once you are done with one thing, you need to continuously monitor that particular administration of fund, as a result of which it is a continuous process. Third is wider scope. That is, there are so many activities which are included in the term of financial management, which we are going to deal in the heading of scope of financial management. Next is measuring the performance, that is checking out that whether you are utilizing the funds for the purpose it was borrowed for or sourced for, and to see that you are utilizing the same in an effective manner. Next is it is related to all the disciplines in which we are going to study its relation with economics, relation with accountancy, relation with mathematics, and relationship with other branches of management. And last is financial management is of utmost importance at the time of decision making. Whenever I'm talking about decision making, financial management mainly focuses on 3 types of decisions, which are written over here. It is talking about financing decision, investment decision, and dividend decision. Since we are going to deal with this in detail in the latter parts of this chapter, I am not taking it in detail as of now. Next is finance and related disciplines, like how the various concepts of financial management are derived from the different concepts of the various studies. First is its relation with economics. As we understood, economics can be broadly classified into two kinds of concepts, that are macroeconomic concepts and microeconomic concepts. Now, there are certain concepts of macroeconomics like GDP growth rate, rate of interest, corporate tax, etc., which are applicable at a global level, or you can say the national level. So it is not particular to a particular business. It is applicable as an industrial level or as a national level or as a global level. Now, these concepts which are written over here of the macroeconomics are directly helpful in calculating the financial management concepts like financial leverage. That is basically how much debt and how much equity should I have at the time of planning my capital structure. Second is capital structure itself. Third is dividend decision. When I think about how much should I retain and how much should I pay off, I need to decide the benefit and the tax management also. So at that particular point of time, the concept of corporate taxes helps me out for the same. Next is timing of raising fund. As a particular financial manager, you always wait for the right time to raise your fund. You check out the cost of capital on a continuous basis, and the time you feel that the economy is undergoing at that particular point of time, you will raise your fund at a lower cost. Basically, again, the timing for raising the fund is important, and it is being determined on the basis of macroeconomic scenario. So basically, these concepts are being calculated by understanding or using the knowledge of this particular concepts of macroeconomics. Second is microeconomic concepts like marginal analysis, cost benefit analysis, break even analysis. I hope you are aware about what is the meaning of this particular part. Now, this concepts has been used in calculating various financial concepts like optimum finance mix. That is, I need to adjust my overall capital structure in such a manner. That is, कितना debt होना चाहिए, कितना equity होना चाहिए, how much should be my reserve. I need to select it in such a manner that my cost is minimum and my return is maximum. It is nothing. It is my cost benefit analysis. Second is product pricing. That is, at what price I should price my particular product so that I can cover all my expenses. And third is optimum cash level. That is, I should not be left with more cash, or I should not be left with less cash. That is, it should not be excess, it should not be undergoing. Why? Because the main point is, for example, if I'm feeling shortage of funds, shortage of cash, and I won't be able to meet my day-to-day expenses, my routine expenses, which is a bad sign for a business. Now, at the same time, if I'm having more amount of cash on my hand, then in that particular case, what will happen? I am keeping my cash idle. So if I would have invested that amount somewhere else, I may have earned good amount of return. But since I am having idle cash on my hand, then in that particular case, what will happen? In that particular case, I am missing the opportunity of earning the excess returns. So again, the microeconomic factors helps me out at the time of deciding about financial concepts. I hope I'm clear with this particular slide. It shows the relationship between financial management and economics. Second is financial management and accounting. I have written it in a form of difference because we are basically going to look into the points which basically differs between the concept of accounting and financial management. As you all know, accounting deals with record keeping. That is, once you are entering into a transaction, you are recording the transaction in your books of accounts. It is accounting. While financial management talks about value maximizing, the main aim, the main objective of financial management is to maximize the wealth of the shareholders. As a result of which, this is a record keeping process, well, this is a value maximizing process. Accounting always talks about past data, the transactions that are already incurred, while financial management always talks about projections, that is the future data, like what is going to happen. You are going to project something that is going to happen, fine. So it is dealing with the future data. As a result of which, accounting talks about certainty, that is something that has already taken place, that is 100% sure, while financial management always talks about uncertainty because it has not happened till date, it is going to take place in future. Next is accounting is using accrual method, that is, it is recording all the transaction which relates to a particular year, while financial management talks about cash flow method, that is, it is recording the transaction on the basis of cash. That is, whenever I am receiving any cash, I am going to record it as my income. Whenever I am paying any cash, I am going to record it as my expense. I am not concerned with the time period, fine. What I am concerned with the cash receipts and cash payment. So accounting deals with accrual method, while financial management deals with cash flow method. Accounting provides you the basis for tax payment. As you all know, the tax is paid on the total amount of income that you have earned in a particular financial year. Now, accounting helps you out to calculate your net profit on which you are supposed to pay tax. So it is providing you the base for tax payment. While financial management talks about tax planning, that is, it is going to think about how much you should borrow and how much you should invest in many projects, how much you should retain and how much you should give as a dividend in order to plan your tax and to reduce your tax liability. So basically, again, the base for tax calculation has been provided by accounting, while the tax planning is being done under financial management. And the last and the important point is accounting evaluates the financial condition by finding out the deviations. So what does basically accounting is doing is it is evaluating my financial condition of a business by finding out the deviation, like itna hona chahiye tha aur actually performance mein ye hua hai. So basically what I'm doing is I'm just finding out the deviation, so I can know how much I am actually spending more or how much I'm actually spending less. I can get that particular deviation amount. But financial management is going a step ahead. What it is going, it is controlling the financial condition by taking necessary decisions. So deviations are well relevant and it is visible by accounting, but how to control those deviations, these steps for the same are being taken by the financial management. So importantly, just need to remember one important point. Accounting basically talks about the transactions that have already incurred. So it is dealing with historic data or past data, while financial management is going to talk about the projections. So it is going to deal with the future data. This is all about financial management and accounting. Next is financial management and mathematics. As we all know, under mathematics, we have studied various concepts like addition, subtraction, multiplication, division, average, weighted average, annuity, power and exponent, etc. All this calculative part is going to be used while calculating various financial management concepts and fundamentals. Like I want to determine the optimum capital structure, like the ratio of debt and equity. Now in this particular case, I'm going to use the fundamental of weighted average. I want to calculate EPS, that is earning per share. The formula is profit available for shareholders divided by number of equity shares. What is this? It is a division. So basically all these concepts that I have written over here, somewhere or the other, I'm going to use the mathematical concept that I have learned in the form of all these points. I hope I'm clear with this too. Okay. This slide basically talks about relationship between financial management and other management areas. First is production management. Whenever I'm talking about production management, I focus on three important terms, that is raw materials, labors and overheads. These are the basic inputs in order to complete my production process. Now, in order to do production of my particular product, I need to give payment to all my resources, as a result of which financial management helps me out by providing fund to do payment of all these resources. Second is materials management. Whenever I'm talking about materials, that is raw materials, I am incurring basically two kind of cost with respect to sale. First is ordering cost and second is carrying cost. Ordering cost is whenever you are placing an order for a material, you incur expenditure, right? Regarding the stationery expenses, the transportation expenses, etc. This is a part of your ordering cost. And second is carrying cost or storage cost. Suppose you have purchased the raw material and you have received the same. Now you need to store that with you, as a result of which you may hire a warehouse. Fine, you need to keep a warehouse keeper to whom you are going to pay salary. You need to take insurance of your goods or stock, what you can say, as a result of which you are going to pay insurance premium. You need to maintain the same, so you need to incur certain maintenance cost, etc. So basically, again, expenditure or you can say cash payment is involved in maintaining or managing your materials. So again, who is coming to your rescue? Financial management. Third is marketing management. We can say both this concept, that is marketing management and financial management, are interrelated. How? Let's see that. First is marketing management earns income from financial management by sales. Now you know financial management is the department which is basically providing cash funds to all the departments. Now they need cash, fine. So from where they are going to collect their cash? From the sales revenue of the business. Now in order to increase the sales, marketing management basically plans various strategies by which it increases the sales of the company. So I can say, who helps financial management to earn cash receipts? Answer is marketing management. And in return for marketing expenses like advertisement, publicity, fine, when you can say giving sales commission to the sales workforce, etc. All these expenses are my marketing expenses. Now again, fund is needed for this particular topic, and who is going to provide the fund? Financial management. In short, both these disciplines are interrelated. Last is personnel management. You can say it as a human resource management, from recruitment, selection, training to post-retirement activities. In each and everything, companies required to spend something. Now, in order to spend this particular amount, the amount is being provided by the financial management. They need to pay regular salary and wages to their employees and workers. Again, they require money. From where the money is going to come? It is going to come from the financial management. In short, by this, we had understood that all the branches of management, all the areas of management are related directly or indirectly with the term of financial management. So this was the second important part of this chapter, under which I had explained you like what is the relationship of financial management with various disciplines like economics, accounting, mathematics, and all the management areas. I hope you are clear with this. Okay, let's move ahead. The third important topic is long answer, scope of financial management. Like what all are the activities which are included under the head of financial management. To classify it broadly, I can classify it into three categories. First is financing activity, which basically talks about raising of funds. Paisa aayega kahan se? Second is investing activity, which is basically talking about using of funds, where you are going to invest. And third is dividend policy, which basically going to talk about management of earnings. That is whatsoever profit you have earned, how much you are going to retain it in form of reserves and how much you are going to distribute it to the shareholders in form of dividend. Let's see it in detail. The first part is raising of fund, that is financing decision. Now what all are the points which are included under the financing activity? The first is determining long-term and short-term capital requirements. For example, if I want to start a project, I want to invest in a project, I need to estimate how much capital do I require for this particular point. Now in this case, I need to estimate my requirement. So this is the activity which is done under this particular phase. So my first is estimating my long-term and short-term capital requirements. Kitna paisa chahiyega. Second point is planning for optimum capital structure, that is capital mix, like how much equity should I use, how much borrowed fund should I use, how much reserve should I use, etc. I want to set an optimum structure so that my cost of capital goes minimum. This is my second activity. Third is planning for optimum level of working capital. What is working capital? The capital that you require to pay your routine and day-to-day expenses, current assets minus current liability. So I need to plan that particular amount and estimate that requirement also. Fourth is negotiations with different sources of funds. I have cleared out that I want to borrow 50% of my total capital requirement. Now there are several banks in the country who are ready to provide me loans. Now I need to enter into a negotiation, a win-win negotiation in which I can select the best lender so that the cost of capital at which I'm borrowing the funds is minimum and the terms are quite handy with my business. As a result of which I need to do negotiations with the different providers of the funds. Next, I need to appoint underwriters, bankers, brokers for issue of shares and debentures. Whenever I'm thinking to issue shares or debentures, then there are certain procedure that I need to comply with, under which I need to appoint an underwriter. Who is underwriter? If your shares are not subscribed fully, then they are the person who guarantee that the remaining portion will be purchased by this people. They are known as underwriters, who are the guarantors that if something remain unsubscribed, they are going to subscribe the same. Second is bankers, that is the process is being going to be carried out by the banks. So you need to hire particular bankers in their particular process. And third one is brokers, who are going to find out the customers who are going to invest in your company. And last point is adopting proper procedure for raising funds. You need to comply with the proper procedure and it is being guided by the proper appropriate authority. I hope I'm clear with this. I'm just giving you a moment. Take a quick view on all the points which are stated under this head. Well, let's move ahead to the next activity. This is using of funds, that is investing decision. under which I am supposed to decide where should I invest my funds that I had already borrowed in my first part, that is financing activity. First is I am going to take my long-term investment decisions, that is capital budgeting, that I guess you are clear with that particular topic also. Second is selection of a proper project for investment. I need to do a rational selection, like which project is actually going to increase wealth for my business. So I need to select the proper project. Third is I need to see to it that the completion of the project is within the time limit, because as far as there is a delay in my project, my capital is going to get blocked, as a result of which I may not be able to earn good amount of return on the investment that I had done. So it is necessary for a finance manager to look into that the project are being completed in the particular time limit. Next is to bring financial coordination between the various departments. This is again an important part, because unless and until there is a proper coordination amongst various departments, you cannot perform your business activities in a smooth manner. As a result of which, you need to set out a proper financial coordination, you need to plan appropriate budget for each and every department so that they can carry out their activities in an efficient manner. Next is exercising control over utilization of funds. You need to strictly monitor the usage of funds. जो पर्पस के लिए जितना पैसा यूज होना चाहिए था, you need to check it out that it is being used for that purpose only. There is no deviation in the usage of funds. And the last part is management of short-term finance, that is day-to-day requirement. I need to manage same also. For that, I'm going to take care about working capital decisions. So for long-term investment decisions, it is capital budgeting technique, and for short-term, it is working capital. This is all about investing decision. That is point number 2. The third one is management of earnings, or I can say it is dividend decision. Now, what all activities are included in my dividend decision? Let's check out. First is tax planning. As I discussed earlier, as a finance manager, I need to plan my tax. That is, if I'm going to pay or distribute the amount to my shareholders, then am I going to reduce my tax liability, or shall I retain that amount which is going to reduce my tax liability? So I need to basically plan my tax, from where should I borrow my funds and where should I invest, so that my entire tax liability is going down. Second is I need to take a decision regarding allocation of profit between different types of reserves, because I know there are various reserves which are being prepared for various requirements. Now, what is my main target? Is it diversification? It is modernization? Is it expansion? According to my target or my future vision, I need to allocate the profit. Next is I need to think about payment of dividend, interest and taxes. Next is payment of installments if any loans are being taken by me. Next is need for retained earnings for future targets. If I decided that I am going to expand my business in coming 5 years, I may require fund for that expansion also, and I am relying on my reserves. So I would make sure that I am allocating sufficient amount of my profit into that reserves so that it can help me out at the time of expansion. And the last one is retention ratio and dividend payout ratio. What is this? For example, I have earned 10 rupees per share as a profit. Now I decide that out of those 10 rupees, I am going to keep with me 4 rupees as a reserves. So what is my retention ratio? 40%. That is 4 on 10. And I am going to pay out 6 rupees as dividend. So what is my payout ratio? It is 60%. So it is retention ratio and payout ratio. So friends, by this, I hope you are clear with the topic of scope of financial management. It is an important question which may come in your examination. So basically, you need to explain in detail all the 3 decisions, that is financing decision, investment decision, and dividend decision. Let's move to the next topic. The name of this topic is goals of financial management. Why financial management? What is the objective of financial management? Broadly, these goals are classified into 2 types: basic or the fundamental goals and the other goals. Under basic goals, we are going to study in detail 2 topics. First is profit maximization and second is wealth maximization. Others are not supposed to be dealt in detail, but if it comes in exam, you can state these points and explain it in 2 to 3 lines. Let's see to it what is written over here. In others, first point is I need to ensure that I am providing fair return to the shareholders. That is, I need to properly see that shareholders are getting good return on the capital that they have invested. It should not like be the case that they had very risk-free opportunities at some alternative sources. So I should at least assure that what they are getting in the market, I should assure that I am also giving the same amount of return to my shareholders, at least that much amount. Second is reserves for growth and expansion. I need to keep in mind my requirements for growth and expansion, and I need to earn by keeping that particular point in mind. So I need to create appropriate resource for that particular purpose. Next is maximum operational efficiency. I need to see to it that the efficiency with which all the operations or the transactions are being carried out in my particular business are at optimum. That is, for example, till now I was using 1 kg of raw material to produce 1 kg of finished goods. I need to ensure that how by using the 90 points of that particular raw material I am producing the same output. So what I need to focus on is I need to improve my processes in order to make myself efficient. And the fourth part is ensure that financial discipline is being maintained. All the financial policies are duly complied with. So these are the some other objectives of financial management. Let's now focus on the main ones. That is, first one is profit maximization. Why you need to earn profit? Why profit is required? To meet your cost, that is your expenses, and to provide funds for your growth. Profit shows your efficiency, that is how efficiently you are running your business. It is helpful to measure your firm's performance, that how well you have performed. It is being reflected by your profit that you have earned in a particular year. It helps you to provide protection against any kind of risk. For example, you are having any kind of risk and you are having sufficient amount of profit in your hand, you can easily tackle that particular risk. And last is, if market scenario is such that there are slump period, depression period, and the market that you have expected is not the case as of now, then under such scenario also, when there are market fluctuations, you are able to retain your sales. Why? Because you are having sufficient amount on your hand in terms of profit. So basically these are the basic points which says why profit is important. Now, what are the points which are in favor of the concept of profit maximization? That is, the goal of financial management is profit maximization. It is to earn more and more profit, to increase your profit at the highest level. Now, which are the points which are favoring this point? Let us see that. First is maximum welfare to the shareholders. It is definite point. If I'm earning good amount of profit, the welfare of my shareholders is going to be more, because it is after all the money that is going into the hand of my shareholders. Second is it boosts confidence of management for expansion and modernization. If management feels that they are earning good amount of profit, then they will be feeling free and feel confident to take the decisions with respect to expansion and modernization. Third is it attracts investors to invest. One of the important point. If your books of accounts show good amount of profit, then the investors who are willing to invest their money in the businesses, they would be attracted. Why? Because they know this company is generating good amount of return, so they are going to timely repay their own money that they are going to invest. As a result of which, investors would be attracted to come and join your particular business. Next point is it indicates the optimum utilization of funds. When you can earn profit, when you are utilizing your funds in an efficient manner, in an optimum manner. So it is nothing, it is the reflect of that particular thing. Last is it ensures survival during the adverse market condition. As I had already discussed, when you feel there is a time of depression, during that particular time also you are able to survive your particular business when you are having good amount of profit. So all these points which are written over here are favoring the concept of the objective of profit maximization. But now there are certain points which are against this concept, as a result of which we had moved from profit maximization to wealth maximization. So let's check out what are the points which are against the concept of profit maximization. First point is it is a vague concept. Vague means it is a unclear. It is not talking about what profit we are talking about, whether it is profit before tax or profit after tax. It is not clear. Fine. This is your first criticism. Second is most important one. It ignores time value of money. As I told you at the time of our original sessions, what is time value of money? For which I use the statement, आज का 1 रुपया कल के 1 रुपये के बराबर नहीं है. Under which I gave you the example. Suppose 3 months back, I was having 70 rupees in my pocket. I could have purchased 1 liter of petrol out of that 70 rupees. But today, if I go to purchase the petrol, I may get only 0.90 liters of petrol with the same 70 rupees. So currency तो वो की वही है. I was paying 70 rupees, I am paying 70 rupees, but the purchasing power of my currency has gradually reduced. This is the effect of time value of money. That with every passing time, the value of the money in your hand is going to decrease day by day. So what you need to do is you need to adjust your cash flows. It may be your cash inflow, it may be your cash outflow with the factor of time value of money. So this concept was being ignored at the time of calculating profit. And so we had moved to the concept of wealth maximization. Third point is it cannot be justified in monopoly market. What they're telling is the concept of profit maximization. It cannot be justified in monopoly market. Why it cannot be justified? Because it is simple. Under monopoly market there is only one firm. Fine, if one firm is doing a business, it is definite that they are only going to earn profit, so you cannot measure the real performance of that particular business firm. Next is it implies exploitation of employees, customers, and society. If you want to earn more profit, what you will do? You may pay lesser salaries for your employees. You may provide the quality at a higher. You may provide your product at a higher prices or at a inferior quality in order to increase the profit. What you are doing? You are exploiting your stakeholders. It ignores future risk. I'm not talking about future, I'm just talking about what is my present situation and what has already occurred. So profit maximization concept basically ignores what are the future risks that a business is going to face. And last is it attracts competition and government interference. It is but nature. If someone comes to know the business you are doing it is earning very good amount of profit, then all the people are going to be interested to do the business that you are being carrying on. As a result of which, it is going to increase the competition. At the same time, government interference will increase. Why? Because they are going to demand for the tax amount, as a result of which they would start interfering in your business. So these all are the points which are against the concept of profit maximization. So we come up with the concept of wealth maximization as the main objective of financial management. What is wealth? Assets employed for generation of further wealth. So in order to create further wealth, whatsoever amount I'm investing in my business, it is my wealth. Now I had a concept of NPV that I guess you are already well aware. It stands for net present value. What is the formula? Present value of cash inflows minus present value of cash outflows. What I'm doing is I'm converting all my future cash inflows that I'm going to earn from a project, and I'm deducting all my present value of cash outflows that I'm going to spending. So basically what I'm doing is I'm converting all my cash flows into present value, and I'm finally getting particular answer. If the answer of this formula is coming positive, then that project is worth going, and I can say it is going to increase my wealth. But if this answer is negative, then I can say it is going to decrease my wealth. As a result of which, you should accept the project that you might have also studied under the topic of capital budgeting, that if your NPV is positive, you can go for that particular project. You are having a green signal for the same. But if you are having NPV negative, you should not take that particular project. The concept of wealth maximization considers two important things, that is future risk and time value of money. Now, if I want to keep a formula of wealth, what is wealth? That is number of outstanding shares as on particular date. For example, I am having total 1,000 shares of my company. So what are the number of my outstanding shares? It is 1,000. Multiply by market price per share. Market price per share as of now is rupees 10 for my company. So what I'm going to do is 1,000 shares are total of my company which are outstanding, multiplied by 10 rupees per share. The answer is coming to 10,000. It is nothing, it is my total wealth. So in order to calculate your total wealth, what you are going to do is number of outstanding shares multiplied by market price per share. It is going to give you the amount of the wealth. And last is it focus on increase the wealth and welfare of the shareholders. It is but natural. You are talking about wealth maximization. So you are going to think from the direction of how to increase the overall capital, overall wealth of your business. As a result of which, it is going to focus on the welfare and increase in wealth of your shareholders. What are the points in favor? Now we are clear with that it considers time value of money, it takes care of interest of all the stakeholders, it considers future risk, it implies for long run survival, and lastly it increases the market price or the business valuation. It is much more clear because we had already discussed all these points ago. What is the limitation, or what are the points which are against the concept of wealth maximization? The most important point is rate of discount. As I have told you, I need to discount or adjust my cash flows with my present value. Now, to determine what should be the appropriate rate of discount with which I should consider or convert my cash flows into present value is a subject of question. It changes from person to person. Like if I am a financial manager, I can say, sir, 7% is an ideal percentage to discount my cash flows. If you are the financial manager, you may feel, no, sir, 6% is the ideal way. So basically, this concept of rate of discount changes from person to person. as a result of which I can say this concept is a subjective one. That is, it is not uniform or consistent. From one manager to another manager, this concept is going to differ. This is one of the point which is against the concept of wealth maximization. Next point is critics say that is लोगों का काम है कुछ तो बुराई निकालेंगे. As a result of which these 2 points are such which you can say they may not be the real limitations, but they are being opposed or put forward by certain critics. First point is wealth maximization is not possible without profit maximization. That is, if you want to increase your wealth, first of all you need to increase your profit. So wealth maximization is secondary one. First you need to focus on profit maximization. This is what critics have said. And the second part is being distinction between the shareholders, that is the owners of the business, and directors who are the managers of the business. Managers may focus more on profit than wealth. I know that I am going to get my commission or my salary as a percentage of profit. So as a manager or a director, I won't be interested to increase the wealth for my shareholders. Why? Because my monetary returns are basically based on the amount of profit that I am earning. As a result of which, it may be a prejudicial term that all the management would be focusing more on earning good amount of profit rather than focusing on increasing the wealth of the shareholders. With this, I hope you are clear with the topic of profit maximization and wealth maximization. This is just a difference. Again, the repetitions, I'm not taking the same. Now we are going to study evaluation of financial management. The concept of financial management that we are studying today is not as of now only. It had been evolved through phases. There are basically 3 phases from which this concept has passed through. Those phases are traditional approach, transitional approach, and modern approach. You just need to remember these 3 names: traditional, transitional, and modern approach. The first one was traditional approach. It started in 1900 and it ended up to 4th decade of 20th century. So I can say from 1900 to 1940, this 40 years were basically the era of traditional approach of financial management. What was my main focus? It was just on raising of funds. That is, paisa aayega kahan se? I was just thinking about only one thing, about raising of my finance, raising of my funds. Financial management mainly functions for episodic events only. That is, it is not a continuous process. It is an event-based process. Like if you're having certain events like incorporation of a company, expansion of your company, or amalgamation of merger of a company, you are going to give a thought about financial management, or else you are not going to think about that particular part. So when any episode or any event comes up, I am going to consider financial management concept, or else I am not going to take care of that particular thing. In short, what I want to say is this was only an episodic concept. It is not a continuous one as per the traditional approach. And last is utilization of funds. That is, paisa use kahan pe hona hai, were taken care of by board of directors only. So it was outside the purview of financial management. So only 2 things to remember, 3 things to remember over here. First is the year, that is up to 4 decades of 20th century. We had traditional approach. Focus was only on one part, that is my raising of funds. That is only financing activity. I was not talking about investment. I was not talking about dividend. And the third one is it was episode based events. That is, I am focusing on financial management only when certain events come up. I am not taking it as a continuous activity. Then came up the second part, that is transitional approach. Under transitional approach, it began around early 40s and continued up to mid 50s. So basically it began in 1940s and continued into mid 50s. What was the major focus? Raising of funds, that was already there in the previous approach. Plus it was also focusing on day-to-day problems. So this is an addition, that I was focusing on raising of funds as well as I'm thinking about my day-to-day problems. That is my day-to-day financial requirements. Fund analysis, financial planning and control were in focus, and day-to-day problems of financial manager were solved using managerial techniques like planning and controlling. Again, the important points to remember over here is the time period, that it began in early 40s and continued up to mid 50s. And second, it is focusing on 2 important points as of now: raising of funds and taking care of my day-to-day problems. So taking care of my day-to-day problems is something added as compared to my traditional approach. So when I came from traditional to transitional, I started taking care of my day-to-day problems. That is my day-to-day financial requirements, my day-to-day payments for raw materials, laborers, etc. Fine. And the last one comes is the modern approach that we are studying till date. It began around mid 50s and it is continuing even today. it is considering all the forms of business, that is corporate as well as non-corporate. This is one of the most important part. Whenever I was talking about traditional approach, it was having only company form in its center. So when I want to fit my business, which is a partnership business or a HUF business, I cannot fit that particular business in my traditional approach. But whenever I'm talking about modern approach, it is covering corporate as well as non-corporates. So every form of organization can fit in my modern approach. What is my major focus? As we have studied, it is raising plus utilizing plus management of funds. So it is talking about all three decisions: financing decisions, investment decisions, and dividend decisions. In this particular answer, you need to write all the points from the answer of topic of scope of financial management, under which we had discussed in detail, like what all points are covered under raising activities, that is financing activities, what all under investing or utilizing, and what all under dividend or management of earnings. So you need to take your points from that answer and add in this particular answer if asked in your examination. Modern concept is not an incident based concept. What it talks about is it is an integral part of my day-to-day business. So in my traditional approach, it was episodic event based. The financial management was being considered only when something takes place, like incorporation, expansion, merger, etc. But whenever I'm in a modern approach, I'm taking it as an integral part of my day-to-day activity. So it is a continuous process. And there are various techniques which are used in this particular point. So this is basically, friends, the concept of evolution, that how financial management that we are having today has been evolved through various phases. So we had studied three phases. First was traditional one, second was transitional, and third was modern approach. I hope I'm clear with this. The last part is functions of finance, that I hope you all are now well aware, like what are the functions of finance: finance decisions, investment decisions, and dividend and liquidity decisions. What are my finance decisions? First is it is talking about cost of capital. Second is it is talking about capital structure, that is, I guess you are clear now, how much equity, how much debt, how much retained earning. To take a decision on this particular point is a part of capital structure. And third is leverage, that is, how much debt, how much borrowed funds should I use in order to increase the earning of my shareholders. This is the concept of leverage. So all these decisions are under the part of finance decisions. Under investment decisions, we are having two kind of investment decisions. First is long term and second is short term. So when it comes to long term, it is capital budgeting, and when it comes to short term, it is working capital. And third is dividend, under which I'm talking about 2 points: dividend policy, that is how much should I pay to my shareholders and distribute among them, and second is retained earnings, that is how much reserve should I keep in order to expand and modernize my business. So all these are the functions of finance. Quickly take a view on this particular point and all the decisions, after which we are going to start with the last topic, that is functions of finance manager. Well, then let's move ahead to the last topic for the day of your revision batch. It is functions or role of finance manager. Like as a finance manager, what all are my functions? Basically, my functions have been classified as two kinds. First is functions as a staff officer, and second is going to come as a functions as a line officer. Now, what is staff officer? Basically, staff officer is an expert in his own field. So it is consulted by BOD, that is Board of Directors. So basically under this heading, we are going to study the functions of finance manager as a staff officer, that is as an expert of the particular subject. Now, if I'm an expert of my subject, Board of Directors are going to consult me before taking any decisions with respect to any of the points which are written over here. So let's see what are the points. First is on launching a new project. That is, whensoever Board of Directors think of launching any new project, they are going to take my advice. Second is regarding the capitalization, like how much capital or what is the estimated capital requirement for a particular project. Next is while designing capital structure, like how much should be the amount of equity, what should be the proportion of debt, etc. During amalgamation takeover, when two businesses are merging or one business is taking over the another. Next is declaring dividend. That is how much dividend should be passed on to the shareholders or how much should be retained. Again, during that part, my consultancy is taken as a finance manager. And last is whenever the time comes to negotiate with the trade union. Who are the trade union? The person who represent the workforce or the employees. So if there are any demands of my employees, they are being put forward to the management by the trade union. So I need to enter into a negotiation which is in a win-win situation. That is, my workers or trade union group are also happy, and I am also happy that I am also not incurring additional costs. As a result of which, all these are the subject areas where my consultancy is being taken, being an expert of this particular field. As a result of which, all this, like providing advice on all these topics, is my function as a finance manager, as a staff officer. I hope you are clear with what are my functions as a staff officer. Let's move to the second part. Functions as a line officer. This is basically as a head of finance department. I'm finance manager. So basically I'm the head of the finance department. So now as a head of the finance department, what are my functions? That is my functions as a line officer. Broadly, my functions as a line officer are classified into two parts: managerial functions and second is administrative functions. First, take managerial functions. First point is financial planning. That is, I need to take care of all these points at the time of financial planning. First is capitalization. That is the estimated amount of capital required. Second is sources. That is which sources I'm going to go for to collect that capital. Whether I'm going to use equity, I'm going for preference shares, or I'm going to take loan. What all are the sources? Third is cost of capital. Fine. I need to consider the cost at which I'm going to borrow the capital from outside. Policies, that are the rules that I need to follow in my particular company with regard to utilization of funds. And last is standards, that is the target that I am setting in order to achieve and in order to evaluate my performance. So basically I need to take care about all these points as my first function of financial planning. Second is financial organization. There is a particular structure which is being framed under which there are authorities and responsibilities assigned, and there is a demarcated responsibility and task for each and every person working in that particular structure. So we are having an entire structure, entire organization. Let's take a look over here. This is how the organization of finance department looks like. Who lead this particular department? It is being led by the financial manager. Now basically there are two important functions over here. One is treasurer and second is controller. Treasurer includes basically 5 different kinds of officer. First is cash officer. He takes care about cash receipts and cash payment. Second is credit officer. He basically takes care about the amount of collections or the credit sales that are being provided, means any funds which are being provided on credit. Third is portfolio officer. He basically takes care about the investment, like which assets should be invested in. Next is fundraising officer, under which he is going to take care about what are the areas from where I can raise my money, raise my capital. Last is capital budgeting officer. He is going to take care about which proposal or which project to invest in and which project to opt out from. These all are the functions as a treasurer. Now as a controller, first is financial accounting officer, that is recording each and every transaction that are taking place in my day-to-day activities. Second, cost accounting officer, that is to focus on cost per unit of any of my product. Next is taxation officer, who basically provides me guidance on the taxation matters. What should I do as a finance manager so that I can reduce the overall tax liability of my company and I can do my tax planning in a much better manner. Next is data processing officer. He basically takes care about each and every data which is available to him. He processes the same and gives us the trend, like what activities should we go for in order to make our business revenue more profitable. And last is internal auditor. He basically takes care about the examination and he checks that whether each and everything are being going as per it is supposed to be done or not. So basically these are the roles in the organization of financial department. Third is financial coordination, which is my third function as a managerial function, under which I need to lay stress on the interdepartmental coordination, because if there is no coordination between the departments, it becomes difficult for me as a finance manager to perform my activities. So I need to stress on interdepartment coordination. Fourth is finance control. Control is the same that you have studied in the topic of controlling. What you are doing is you are setting the standards first of all, and you are measuring your performance by using various technique, ratio analysis, cash flow, fund flow, etc. Then you're finding out the deviations, like you're comparing standards with actual performance, and you're finding out where are the loopholes, what are the deviations, and finally you're going to take the corrective action. So basically this process is also conducted by the finance manager as a line officer under the head of financial control. Next, it takes care about management of working capital. Working capital, as I have told you, it is capital that you require for your routine activities, day-to-day activities. It basically focusing on three important decisions: decisions with respect to cash, decisions with respect to receivables or debtors, and with respect to inventories or stock. Next comes management of fixed assets. That is, I need to take care about capital budgeting decisions, like which asset should I go for and purchase for a long-term basis. Last is management of earnings, under which I'm going to decide planning my tax, how much dividend should I pay, and how much money should I retain for my future prospects. So all these functions, friend, are basically functions of finance manager as a line officer. That is, at a head of financial department under the head of managerial functions. Now, let's look quickly at the administrative functions. These are the day-to-day activities that a finance manager is supposed to supervise or get done from his subordinates. First is maintenance of proper books and accounts. He needs to take due care that each and every books and accounts which are necessary, under which all the transactions are recorded, are being maintained properly. Second is he need to oversee the accounting work. That is, day-to-day recording of transactions is being done on a timely basis, and your accounts are maintained on an up-to-date basis. Third is control over cash receipts. That is, he need to take due care that whenever he is having any kind of cash receipt, suppose he is receiving money from the debtors, cash from the debtors, he need to see to it that that cash is properly being recorded in the books of account and at the same time safely kept in the cash box. So basically this is control over cash receipts. At the same time, he looks after the payment of cash. That is, whenever it is payment to creditor, payment to any supplier of raw materials, he need to take due care again that proper amount is being paid. There is a proper recording of the payment in the books of accounts. Next is preparing bank reconciliation statement. As we all know, due to certain timing reasons, there may be mismatch between the bank book and the bank passbook or the bank statement. That is the record that you are accounting and the record which is being maintained by the bank. Like for example, my interest gets credited in my bank statement, that is in my passbook, on the last date of the month, but I come to know about the same on the next day of the, that is, new month. In this particular case, there may be a difference. Fine. So I need to prepare a reconciliation statement that you had already studied in accountancy. So this is again a responsibility of the finance manager as a line officer under his administrative functions. Next is maintenance of important documents with safety. This is again a very important point. When you are issuing any kind of equity shares, all the share certificates are supposed to be duly maintained with you. When you are issuing any kind of deposits, and the deposit certificates are supposed to be properly maintained. Finance manager needs to take due care and there is a proper area for maintenance of all the safe documents. And the last part is maintenance of financial information and financial reporting. Why does it is necessary to maintain all the financial information? Because when sir my top management wants to take any decision, I can provide him up-to-date financial information so that he can easily take out decision on the basis of that particular information. And second one is financial reporting. That is, I should timely report all the activities under my department to the top management so that they can come to know like what are the activities which are being actually performed at the bottom and the middle level of management. I hope, friend, today's lecture would be a great help to you because it may have helped you to solve the doubts that you might be having that may not be clear during the previous lectures. So I request you all to go through once again through this entire lecture so that you'll be having a good amount of clarity on all the topics that we had covered under this particular unit. This is entire theory portion that is you are going to face in your examination. I hope you all are safe at your place and please take utmost due care of your health and your family members' health. With this, I, CA Pujan Kapadia, thank you all for your patient listening and hope to see you soon in my next lecture. And don't forget, friends, you are having your test on my next lecture on Friday. So duly timely appear in the lecture. Thank you.